happy to kick this off and get started and continue the discussion of the blockchain kind of ecosystem and DeFi here. So I'm actually going to share my screen. I have some slides to go along here, if that's okay. All right, here we go. So I kind of came in last minute here. I'm going to kind of just touch upon just the broader ecosystem here, what's happening within DeFi. We'll kind of cover I'm breaking this down kind of between really kind of four subsectors of kind of what's happening currently in the ecosystem. We'll talk about kind of how businesses are adopting some of these various crypto assets, security tokens, NFTs, stablecoins, how this is all impacting business, where things are today, and kind of where things are heading as we go. So let's go ahead and jump in here. So this ecosystem, really about 12 years old or so today. We've seen quite an explosion of growth just in the last 4, 5, 6 years, starting with Bitcoin, and then when Ethereum came onto the scene in 2016, and really saw a lot of growth with ICOs, and we've seen an explosion in NFTs. I think NFTs are probably the word of the year for 2021. And we're seeing really kind of a maturation in the security token spaces as well, primarily in the area of private market assets. And then when we look at payments, quite an explosion of stable coins growing to about 3 times the size of I think the PayPal network itself. So we'll start with crypto assets as kind of the first category within the broader ecosystem. So we think about crypto assets. These are blockchain native digital assets that are really kind of representing these distributed data information networks where the users get to own and also participate in governance of these networks. So really kind of a different model from kind of what we see in the existing Web 2.0 framework, which are more centralized information networks. When we think of something like a Google or Facebook or Amazon, Netflix, these are centralized information networks where users get to access these tools, sometimes for free, but the kind of economic upsides are more centralized and not as distributed as what we see in the Web 3.0 framework. So just kind of give us an overview of where Bitcoin stands today. Bitcoin, almost $1 trillion asset. It was over $1 trillion asset. We've had a little bit of a pullback, but in terms of kind of regulation here, Bitcoin is seen as a commodity by the CFTC, as is Ethereum. So we have some clarity in terms of where these two assets sit. And so with that clarity, we've seen a pretty well-formed derivatives markets, futures markets. We now have a spot ETF that's based out of Canada. We have kind of broad, adoption across exchanges and pretty well-formed markets here. The other thing that we've seen with Bitcoin just over kind of the last few years is, and really kind of started after COVID, was that some publicly traded larger institutions are starting to look at Bitcoin as potentially a hedge against inflation, and putting it on their balance sheets as a treasury asset. So converting some of their cash or cash equivalents on the balance sheet can be, kind of a lower percentage, maybe 5-10%, convert that to Bitcoin and sort of allow themselves to hedge against inflation, which we've seen has become a kind of rising concern for anyone that's holding cash on their balance sheets. So that's kind of an interesting development with Bitcoin. And then the other thing we've seen just this last year is the adoption of Bitcoin as legal tender by a nation state. So we saw El Salvador make Bitcoin legal tender, which is really an interesting development. They're really looking at it more from a perspective for payments and remittances. So El Salvador's about 25% of their GDP comes from remittance payments from their immigrants that are working outside the country and sending money back in. And so they can use the Bitcoin network and kind of that layer 2 Lightning network to send those payments direct, peer-to-peer, and cut out some of the fees that were being paid to, a company like Western Union to transfer that money. So we see like these open protocols really collapse and compress costs, and what the benefit there is you're returning a lot of that GDP to the citizens and to the economy of El Salvador. So as far as Ethereum goes, Ethereum has really kind of taken this idea of what Bitcoin introduced and and really kind of added smart contracts and programmability to what we can see develop on Ethereum. So that's really where DeFi has exploded. For the most part, I think about 75% of the DeFi market is on Ethereum today. We do have some other layer one blockchains that are also seeing an explosion of NFTs on Solana, Avalanche, with some decentralized finance applications as well. So as far as regulation, as I said, Bitcoin, Ethereum are commodities. And then after that is where it gets much more murky. Most of the rest of the space does look like it's fitting more into the security bucket. But nothing has really been registered as securities. And so it's really more of a Wild West approach today, where we're really looking for more guidance to come down from the SEC to determine, how we're going to treat some of these DeFi protocols going forward. So kind of the next subsector that I want to talk about is security tokens. So we've seen really kind of a lot of growth with security tokens, and the regulatory and compliance with these is pretty straightforward. These are existing securities that we're essentially just dematerializing, moving them into a digital format, putting on a blockchain, and there's a number of benefits to doing so. And it really comes back to, private markets are typically a little bit more illiquid than public markets. And so if you take an asset like commercial real estate, for example, typically takes 3 to 6 months to convert a real estate property to cash or cash equivalents and kind of get that liquidity out of the property. And so what we're seeing with private real estate is we now have the ability to take all the relevant data related to a commercial property, for example, the audited financial statements, the any of the capital project data, legal data, building efficiency data, anything that would be needed to price that asset, we can pin that onto a blockchain as a single source of truth, because this is valuable enterprise data that these companies have, and then we can commute that data through the blockchain to the market. And so what that can do is help us establish price discovery, add liquidity, and start to unlock value across some of these private market assets like commercial real estate, private equity, private fixed income. And we really think that private markets are going to kind of lead this charge with digital assets because of the features and the ability to commute data into the market, allow market participants to converge around that data and establish price discovery. So some interesting developments kind of happening in the security token space. And just to kind of expand on this a little bit, we've seen just over the last 15 years or so, quite a move into private markets. I think a lot of this has to do with just monetary policy, interest rates being pinned down to zero, and investors starting to rethink kind of portfolio allocations. I think BlackRock has kind of been beating the drum on this a little bit, where kind of advising clients to move away from the 60-40 equity to fixed income allocation, and to start to consider more of a 50-30-20 allocation, with 20% going to alternative assets. And that's really the bucket that private market assets would fit into. And then just to give us an idea of kind of the scope of private markets compared to public markets. Private markets, a lot of people don't realize this, are much larger than the public markets. So if you look at just private real estate, it's a $317 trillion asset class. That's 32 times the size of public real estate. Private debt, 2.5 times the size of public debt. Then we look at private equity, 4.5 times. So we really think that private markets, this need for liquidity, we have a lot of data-rich assets that are impaired with price discovery, and we think blockchain technology is going to really enhance the ability to provide that data, which leads to price discovery, which leads to liquidity, which eventually unlocks value. So, and not to get too technical, but this is just kind of the emerging kind of tech stack of kind of how this ecosystem is forming, where we can anchor a lot of this property data would be sort of in the second layer. We're anchoring that into a layer 1 blockchain, such as Ethereum, Polygon, really any of these layer 1 blockchains. And then we can use those middleware solutions to kind of increase transaction speed, increase security, and really kind of at this tokenization layer is where an owner of that data can really start to monetize that data, where they can automate, fund services, capital calls, distributions, handle all of that KYC, AML compliance, manage capital tables. All of that can kind of happen at this tokenization layer, which is integrating with some of these large custody providers and ultimately integrating with some of the global exchanges. And we see this sort of kind of coming together where we can start to see really kind of highly liquid secondary markets for private market assets forming within the next 2 to 4 years, let's call it. So moving over to NFTs and digital property. So really what NFTs are representing is the right for users to control their property, which is really a big idea. And so one of the kind of areas to keep an eye on here is really in the gaming industry. So the gaming industry, it's the largest and fastest growing form of entertainment globally. The gaming industry is about $180 billion market in terms of revenues per year, which is twice the size of the global film industry and twice the size of all 4 major American sports combined. So really large industry growing. We're seeing an explosion of kind of innovation with blockchain gaming. And the key thing here is that we're able to use NFTs where the gamers themselves get to control their in-game assets, control their abilities within those games, and monetize their time spent playing the game. So there's a game called Axiomfinity that's built on the Ethereum blockchain, and that's just in the last 6 or 7 months produced $1.2 billion of revenue for the users of that game. So people are being paid to play video games, and really NFTs are the vehicle which is unlocking that ability. So not only can users enhance their abilities within the games, earn cryptocurrency, cash out to fiat currencies if they want. They can also, create NFTs, trade their NFTs, control their in-game assets, control their skins or avatars. So some interesting kind of gaming economies forming in the blockchain space. So then we have art, music, ticketing. So art and music really kind of in the entertainment industry, we've seen an explosion of artists getting involved, minting NFTs, selling those NFTs out. The benefit here is that artists are able to really kind of go direct to their fans, cut out a lot of the distribution layers, and kind of getting their work out into the market. And then with smart contracts and the ability to control the secondary trading of that art. So if somebody bought an NFT and wanted to resell that, you'd have the ability to kick off a smart contract where the creator would get a percentage of that resale value. So some interesting developments there. Same idea with music. So musicians can create a recording of their music, mint that as an NFT, and then they have the distribution on a platform like OpenSea, where they can go direct to their fans, and again, cut out a lot of that, those kind of intermediary layers where some of that value is moving away from the creator of the content. So for example, Spotify has about 8 million musicians that use Spotify, and only about 14,000 today are earning a salary of over $50,000. And so kind of gives you an idea of just the layers of intermediation that are pulling dollars from these musicians through those distribution channels. In terms of ticketing, ticketing is another interesting area for NFTs, primarily just for that resale markets where if an issuer of a ticket were to sell the ticket to someone, they resell it. The original issuer would get a piece of that resale value. So kind of another interesting use case we're seeing. The other areas that are starting to kind of see a lot of adoption and we think are really going to accelerate in the years to come is these brand loyalty programs. So we're seeing in the entertainment industry, I think almost every NBA team is now partnered with an issuer of NFTs where they can issue NFTs for their most loyal fans, and through that NFT, provide the access to, maybe some sort of, voting on a new uniform or the ability to access playoff tickets or maybe like a free hot dog at the game. It's a way to kind of build that brand loyalty with your most loyal fans. And then in the metaverse, I think we alluded to this a little bit earlier. I think we're going to see some of these major brands like Adidas, Nike have already partnered with some NFT providers into this space where we're going to see people that want to buy a pair of Nikes, but then Nike's also going to issue an NFT as part of when they ship out the shoes, and you'll be able to wear your Nike NFT if you enter the metaverse. So I think we're going to start to see a lot of interesting things with consumer brands and partnerships to get their brands out in the metaverse as well. Then, so the last kind of segment I want to talk about here is stablecoins. So stablecoins, we've seen an explosion in stablecoins for payments. Like I said, we've seen, I think the market cap is close to 130 billion today. This is about 3 times the size of the PayPal network itself. And this demand is just coming from consumers that just see these payment rails as just far superior, and the efficiencies and usability for the end users is just a better experience. And so when we look at just the difference between kind of a digital payment or a digital asset versus traditional payments or traditional assets, there's just so much transparency. There's instant and final settlement with these digital payments. There's peer-to-peer settlement. These markets, are open 24/7, 365 days a year. They're global. Users are controlling their assets. They have that access to clearing and settlement. We're introducing this shared distributed ledger where everybody can kind of coalesce around the same ledger. It's decentralized, it's transparent, and it's immutable. This also reduces fraud for companies that want to accept payments, kind of cut out but not only the fraud, but also the transaction fees associated with receiving payments. So I think if you're an internet company or a SaaS company and you're a global company, this is just kind of a no-brainer to start to move into accepting stablecoins as payments. As far as like the challenges to adoption, we talked a little bit about this earlier. I think identity is a big piece of it, and it may not be a solution that covers the entire space. We may need identity to sort of bring in more institutional players where they can kind of understand who their counterparties are. They can identify themselves through KYC, AML, but also get comfortable with the smart contracts that they're interacting with and who's behind those smart contracts and who their counterparties are. So I think identity will help to bring in more permissioned DeFi, which will accelerate the adoption for institutions. And then just standardization, I think, with smart contracts, with oracles, with really kind of how we're bringing all this data and monetizing this data, we just need standardization. And I think if we get identity regulation first, that will help to facilitate standardization, which should bring in more adoption going forward. And just to wrap this up, I've touched upon this a little bit, where these are really kind of open, permissionless, decentralized information networks where the users are really kind of controlling and owning and participating in governance of the networks. It looks very similar to the early days of the internet when we democratized the access to and the creation of information what blockchains are doing is democratizing the access to and creation of value. So really kind of profound concept, and Web 3.0 is really a representation of that. So I think we can take a few questions. I read an educational newsletter where I go into these topics in much more detail. If anyone's interested, you can check that out. It's the DeFi Report.substack.com. Anybody can follow me on LinkedIn as well. And if you're interested in kind of the security token market and how we're making private market assets more liquid through price discovery, you can reach out to me at Nadeau@Inveniam.io. Thank you.
Brilliant. Thank you so much, Michael. Really informative presentation there. I mean, you're obviously focusing on a very broad range of topics across the space at the moment. Is there anything in particular that you think is going to pose large hurdles, maybe more so than some of the other considerable factors for institutions? You know, do you see these things in different levels of difficulty to overcome?
Yeah, I think that's one of the challenges as well, is that we can't have a different set of regulations for stablecoins versus the DeFi protocols versus engagement with other assets within the ecosystem. I think that's kind of the key thing with stablecoins. It's regulation around the attestation around what's behind those reserves, right? So we need clarity. Everyone needs to understand that what's backing the actual stablecoin itself. And then with DeFi, we talked about this a little bit earlier, but I think institutions, you just can't have the risk of a smart contract hack, in client dollars being lost for something like that. So I think getting identity will help with permission DeFi. It doesn't mean that the entire space will go towards permission DeFi. I think you'll have sort of those parallel highways where retail can still sort of access these protocols in a similar manner to what we're seeing today. But for institutions, there needs to be some sort of identity attached to some of these wallet addresses so that they can understand who they're interacting with in terms of their counterparties.
Well, we haven't really touched on it, but maybe we should. Does insurance play a part in allowing us to get more comfortable with smart contract risk? Because obviously we don't want to strangle innovation. We want to see these new instruments, replicated and funds, being pulled in to make them more liquid. Would the more traditional insurance guys, the Aons of this world, coming into this space and providing, insurance baskets around smart contract risk, do you think this would be something that can help push on the space? Do you think they'll have an appetite for it?
Yeah, I do. I mean, there's a few protocols out there now. Nexus Mutual is one that's built on top of Ethereum, and what they're doing is essentially allowing participants in DeFi to contribute to various smart contract pools to cover these hacks. There are some challenges around this. We just had a hack of the Badger DAO, and I think it was over $50 million hack there. The Nexus Mutual protocol actually did not cover that specific hack because it had something to do with really the way that the hack occurred. It went through kind of the interface of a website, and it wasn't a direct hack on the smart contract. So there's some complexities around standardization there too. Is what is exactly being covered? Is it really broad coverage, or is it more kind of for niche hacks that we're seeing? So I think it will help, and we're certainly seeing. I think we'll see more of that, and I hope that we can start to see that market participants can get comfortable when something does happen, that people are receiving that insurance and that they are covered.
Yeah, it makes absolute sense. I mean, further definition as we kind of expand and these things get more complicated, I think is, key to us ensuring that we're not getting these strangleholds. Brilliant. Thank you so much for a great presentation.